This conference will now be recorded.
Okay. Amine, would you like to kick off the session for us this morning?
Definitely. Good morning, everyone. Welcome to Family Business Atlantic Staying Connected's webinar series. I'm Amine Mousavi, President of Family Business Atlantic. And for those on the line this morning who may not be familiar with our association, we connect and support families in business, SMEs, and entrepreneurs to help drive the Atlantic economy. We offer safe and confidential forums for members to share their business challenges and provide programming platforms like this one here with the support of our trusted advisors. The purpose of these Staying Connected webinars has really been to keep us connected and reinforce that we're not alone during this time. This is the fourth week now that we've been hosting these sessions, and it's really become clear that we're all facing the same challenges together. We all have the same questions and we're all seeking guidance, and we've had our advisors online every week answering these questions for us through these webinars, and we very much thank them for their support. In light of the COVID-19 situation, Family Business Atlantic will be waiving all membership fees until August 31st, and this is for new family business members. This will allow owners and family members to join virtual peer groups, connect with our trusted advisors, and also be a part of programming that will be tailored to the needs of those businesses who must continue to operate during these times. So if you or you know anyone who may benefit from these offerings, myself or Michelle would be happy to have a chat with you after this webinar. So today we are discussing a very hot topic, how COVID-19 is impacting our investments. And today we will gain a better understanding of where and how to invest during these uncertain economic times, and basically what to do to protect wealth. We have an expert with us here today, Andrew McKinnon with SBW Wealth Management. Welcome this morning, Andrew. Thank you for being with us. Andrew is an expert in investments and wealth management, and he's here to answer any questions we may have. A little bit about him. He's a trusted advisor with Family Business Atlantic, and he has been helping grow our membership for numerous years now. He is a partner at SDW Financial, and he works directly with business owners and their families by helping them think outside of the business by looking at areas of tax planning, estate planning, retirement planning, income protection, and life insurance analysis. He is a certified financial planner and chartered life underwriter. He's over 12 years of experience working in the financial service industry. Myself, having known Andrew for a couple of years now, I can surely say that he has been around business all of his life. He's extremely knowledgeable, and you'll see that he has a passion for using best business practices to protect and grow wealth. So again, thank you, Andrew, for being here with us this morning. Before we get started, can we please ask everybody to mute their microphones for now during the presentation? But do ask your questions. There is a chat feature that you'll find at the top corner of the GoToMeeting app. If you click that chat button, there will be a chat that opens up at the bottom of the screen there. So please do type in your questions during the presentation, and we'll see how the presentation goes. Maybe if we have time at the end of it, you can unmute your microphone if you wish to ask a question directly. With that being said, it's all yours, Andrew.
Great, thanks. Thanks, Amine. Yeah, I put together a short presentation in case there was a lot of sustained silence. So it's only 12 slides, and leading up to this, I've had lots of conversations with my clients and kind of asked them, you know, if you are participating in this call, and I did invite some, I'm not sure if they're on right now or not, you know, what would you want to hear? What would you want to talk about? And all of them, without being prompted, said, don't show any graphs and don't get into the weeds. And I'm like, well, that's kind of what the subject is. So I've reduced it to 2 graphs, and one of them has no words, and the other one I'll explain. But really, what they wanted and what I've been doing is having conversations with them, around how they're doing, what's on their mind, how secure they feel, and what they need to feel, more secure. And in every situation, when we talk specifically about their investments, they don't necessarily want to get into the weeds of the investments, though some do, and we certainly can do that. They really wanted to understand what has the impact been on their investments and how that's going to impact their future planning. And I certainly don't want to minimize the impact for those that are entrepreneurs and the significant impact that COVID is having on their business and will continue to have on their business. I kind of intertwine the impact of their business into this presentation, but really trying to focus on a bit more on the investment side outside of their business. But you'll see where I do kind of bring that in. So that's really where I'm going with the presentation. So if I just look at the overview, everyone, they always ask, what do you do for a living? And people in my industry, the most common answer is usually financial advisor, investment advisor, insurance advisor. When people ask me what I do, I say I help entrepreneurs manage the risks of being self-employed. And that's a pretty broad-reaching topic, but really you'll see in this presentation, we talk about several things, and investments happen to be one. So today, just sort of an agenda or discussion overview, we'll sort of just point out some past pandemics, the need to diversify. Unfortunately, some of the conversations I've had with clients around what is protected from creditors if, God forbid, things go the wrong way, what different investors look like in terms of their profile, what owning shares means, financial planning, which is a pretty broad topic, and how different investments have been impacted. As I go through this presentation, again, just want to make sure that people are clear that, ask any questions over on the side. I'm keeping an eye on the chat, and Sarah is running through the screen or the slides for me. So I'll keep going, and if there's a question that's particular to a slide, I'll try and address it, or if people want to ask questions at the end, we can do that as well. So hard to believe, and I don't want to minimize COVID in any way, but if you can see the screen, and I didn't realize it'd be this small, but when you look at the epidemics that have happened basically since the 80s, we often forget that there's actually been a lot of them. There's many different slides that could have been in here, and my point in including this is just to point out that we've kind of been here before. Again, not to the extent of COVID, and I don't want to minimize that, but when we're in the throes of an epidemic, or if you throw an epidemic and we're in the throes of a financial crisis, we've been there before. And when we're in the middle of it, we think that, oh my gosh, we're never going to come out of it, and the skepticism is there. But as we see the trend of the market back to the 80s, obviously you see that it jumps around. My best analogy of the markets is it's like going up an escalator. And I always think about this when I'm at the Halifax airport, because I think it's the longest escalator in Halifax. It's like going up an escalator with a yo-yo. The yo-yo is going up and down, and that's the market on a daily, weekly, monthly, annual basis. But the general trend is the escalator keeping to go up. So that's sort of my simplest analogy. So with these previous epidemics, the numbers in the middle just basically point out that following the epidemic and sort of the bottom of that epidemic, that the markets have been positive in all but 2 examples, one being Ebola and 2 being AIDS back in the 80s, which stretched out over probably the longest period of time. The next question that people often come up with is, well, when was the bottom of each of these? And the only time you can tell when the bottom was is going and looking back, months and weeks later, to say, well, that actually not even weeks, probably months or years later, to be able to say, oh, the bottom occurred on April or May or June or whatever the date was, and that's the only way to realize it. So, my final point with this is since really the 2008 financial crisis, people have forgotten what risk is. I mean, the reality of since 2009, so if I say the crisis happened in 08, recovery's well into 2009, the markets have jumped around. Certainly there's been a few issues in the markets, but generally over that period of time, the market has performed really well, and people have really forgotten what risk is. And this is the reality check again, where we have another crisis related to an epidemic that has caused a financial crisis. So again, we just have to forget or have to remember what risk is, and this is really to point out that where we are. And another thing too, just was reading yesterday, I've been reading a ton of information. We are back to where the markets were, essentially in Canada. We're back to where the markets were in January 2019. And in the work that we're doing with clients and the conversations we're having and the planning that we're updating, you know, if the market doesn't recover and just really does an average of what it's done in the past moving forward, you know, the conversations as simple as we can make it are, you've essentially lost a year and 4 months of contributions or of growth. And when people have that context of, oh, my 30-year working career and hopefully my 20 or 30-year retirement, I've lost 1 year. And sometimes that perspective has been something that has given people a little bit of comfort to say, okay, maybe I will be okay, but show me the impact. And that's something I'll show you later on. So Sarah, when we talk about investing, and this is sort of broader based, not only their investments, but we talk about diversification. And as simple as I can make it, the conversations that we've had with clients around diversifying not only their investments, but other parts of their life, and I'll start out with their business. And, you know, not that we're the driving factor in a client diversifying their business, but, you know, if they're a single line of what they do and they can diversify into new markets, it will certainly help them improve their business in terms of their probably top and bottom line, but hopefully weather their storm. And my example of this, and again, I take no credit for this whatsoever, but I've had this client for 12 years now, and they're a general contractor, so we know the ebbs and flows of being a general contractor. And they've been hit very significantly at different points in time. And what they did was they get into actually property development. So they develop their own multi-unit residential that they build for themselves. So they get the business on the contracting side, and then they have it in their portfolio in terms of rental, but they continue to build buildings for other people. So again, they diversified their business, and that is certainly helping them at this point in time to deal with that. And diversify your net worth. I mean, my conversations, and I won't say a struggle, but helping people recognize in my work with business owners or entrepreneurs that in most situations, 95% of their net worth is tied up in their business and in their house. And both are not liquid. So in diversifying your net worth, it's a struggle to take money out of your business because your business is often your greatest opportunity for return. It's going to provide the highest rate of return of any other investment you're going to have, but it also has the highest amount of risk. And I don't want someone to not go buy a new loader because they need one for their business. But if you can reach a stage of maturity where either you've got enough money generating internally into your business, and or you can use someone else's money, like the banks, and use some of their money to help grow your business and enable you to pull some money out, it'll just help you weather that storm. And whether that be that, you know, you've got money outside the business that now you may need to lend back into the business in a time like this, then you have that ability. Or, you know, you just know you've got some money outside that the business will go through its struggles, but you've sort of got a safety net. You've got something outside that if worst case scenario, you know, the business isn't going to survive, you've got something outside of the business. So that's a struggle, and for all entrepreneurs to figure out when that point is when they can pull money out of their business. But the more that we can sort of diversify their net worth outside of their business and their house, usually the better the outcome is. And then specific to the topic of today is diversifying their investments. I mean, the process of allocating capital in a way that reduces the exposure to any one particular asset or risk. Basically, that means don't put all your eggs in one basket. So we don't just buy one individual stock, bond, security, mutual fund, or anything. We diversify across a bunch of different investments so that hopefully when one thing is down, everything isn't down. And as well, when one thing is up, everything else isn't up. So that diversification for entrepreneurs is not only within their business and their business lines, but also figuring out a time to pull some money out of the business. And then once they've pulled the money out of the business, is don't put it into one thing. And for entrepreneurs too, with diversification, actually, Sarah, if you want to skip to the next one, you know, I would say we're generally more conservative with our investment planning with clients than maybe some other advisors may be, and that's because we work with entrepreneurs. And I think as an entrepreneur, if you pulled money out of your business, you maybe shouldn't take the amount of risk with that money that maybe someone that doesn't own a business should. So again, if I'm working with two 40-year-olds and one 40-year-old is a highly paid executive, they don't own the business and they're very comfortable with risk, then that portfolio might be 100% aggressive. If I'm working with a 40-year-old entrepreneur that they've got, you know, a contracting business or a service business or a storefront in downtown Halifax, if they pull $1 out of their business, they maybe shouldn't take the same amount of risk, because as the market has been impacted right now, it's impacting their business. They maybe don't want to have it had the same impact on their investments. So when we talk about don't put all your eggs in one basket, you know, we talk about asset type. You know, having some cash. Cash is king. Keeping your powder dry, as is often said. So having some cash, fixed income. Fixed income is really bonds. It's probably the easiest analogy that people would think of, bonds or GICs. So things that generally give you some stability, some safety, some security, but not without risk. Equity, so that's stocks, so owning shares in company, and real estate. Again, have a lot of clients that some part of their portfolio is real estate. They own dirt somewhere. And I think that's an important component of the different assets that they own, because each one performs different in different market conditions. And we talk about sector. So again, do we take everyone's money and put it all into financials or natural resources or technology? Just imagine those that were very heavy or 100% weighted in natural resources, how they're feeling today. It's probably a pretty sickening feeling. So we want to make sure that when we're investing people's money, we invest it into different sectors, so that as one sector is impacted, the other one may not be as much, or the other one might be positively impacted. Asset size. So again, you know, people either have a tendency that only want to invest in very large companies that pay dividends, which is great, but there are ebbs and flows in the markets, and you may want to be investing in some of the smaller, I'll say, technology companies that aren't paying out a dividend, but they might grow exponentially, and their share value might grow such that it could have a significant impact in your portfolio. And then geography. So again, investing in Canada, the US, or the world. You know, Canada makes up about 3% of the world economy, and that might be on the high side. The US is about 30. So, you know, we want to make sure that we have people invested not only in Canada, but around the world, but maybe not overexposing themselves to, especially later on in life, where they're invested internationally, and you've got not only the risk of their investments, but then you've got exchange risk and how that impacts on things. And then, though it's not specific to diversifying, we talk about rebalancing. So if we've set a target for a client to have so much investments and so much in Canada, so much in large companies, so much in financials, so much in every one of those different classes, then what we need to do is, if one class does particularly well over time, it could grow the percentage that it allocates for the portfolio, and it may put the client sort of out of where they're comfortable. So I want to be a balanced investor. So 60% of my money is aggressively invested, 40% is conservative. And if I did nothing and didn't rebalance over the last, say, 10 years, my portfolio probably would have grown to be about 80% aggressive and 20% conservative if I didn't rebalance, because I didn't change the investments that had done particularly well. And with a market correction like this, that 80-20 might put me offside for how much risk I'm comfortable and how that risk has impacted my portfolio. So that's why we want to make sure we rebalance regularly, and that people are diversified across all of these categories. And to give you an idea, I went and looked at some numbers for my existing clients. So these aren't industry numbers or anything like that. And I use my own. I'm an aggressive investor. I'm comfortable with risk. I've got 100% of my money in, I'll say, equity-based or stock ownership of companies, and no bonds, no fixed income, no safety. And this is sometimes surprising to people right now, because they read the newspaper and watch the news and they get the pants scared off them. An aggressive investor year to date is down 13%. I'll say an aggressive investor that I would work with. So I use my own portfolio. So I'm down 13% year to date. From last April 29th to this April 29th, I'm down 11. And sometimes when people hear that, like, oh, like, that's not as bad as I thought. Sometimes you take solace in that, but that's just to give you an idea of where a real client is. A lot of times if you ask people what type of investor they think they are, they would say, I'm a balanced investor. It's sort of the default, and whether they are or aren't. So a balanced investor is typically someone that has about 60% aggressive and 40% conservative. A balanced investor right now is down about 6% year to date. So again, not great, but probably not as bad as they might have thought. A 1 year, so from last April to this year, they're down about 3%. So again, just some perspective on that. And the reason that they're at those returns versus what the market has had for returns is because they're diversified. They don't have all of their money in one particular investment. They're diversified across a number. Sarah switched to this. I felt it was important to talk about this in the realm of investing. Again, in working with entrepreneurs, we've had some difficult conversations with some that are really struggling, and some that aren't sure that they're going to come out of this, and that is unfortunate for them, unfortunate for their family, unfortunate for their staff, and unfortunately for the community of Nova Scotia at large, because we need these small business owners to do what they do to help the economy run. But we have had conversations, and hopefully we're having the conversation and it doesn't come to it, but it's making people aware when the questions are, or the topic has come up where they're worried about what would be protected if things go totally sideways for myself and my business. So, you know, this is really to inform them of what is done. And some people have a thought on some things that are protected from creditors that may be accurate, and a lot of times they may not just be aware, or they might actually be wrong. I understand, and I kind of figured that this was going to be recorded, so I'm going to preface this by saying I'm not a lawyer. I do not put pages and pages of disclaimers on there. You'll see my 2 asterisks with a little bit of red down below, and that wouldn't certainly encompass all the exceptions, but I just want this sort of as a broad topic, the conversations we have. So the assets that are protected, and I say potentially, from creditors, this changed a number of years ago, but RRSPs and LIRA, so Registered Retirement Savings Plan, we talk in acronyms, RRSP, most people know what that means. Locked in retirement account, so that is money there, money like an RRSP, but where you worked for a company that had a pension plan, and you left that company and the money rolled out to your personal investments, and it's in a different account than your RRSP. Those are protected from creditors. So in a situation where if someone were to, you know, become insolvent, those assets are potentially protected. I'm going to jump to the bottom and just say deposits made in the last 12 months to an RRSP, or where you might owe money to CRA for income tax and you've not declared bankruptcy, there's a possibility that they can go back. So again, someone who's trying to dump a bunch of money into an RRSP with the expectation or the knowledge that they're going to go under, obviously they can go back and get the access to that money. But if someone has shown a disciplined approach to putting money into RRSPs over the years, that is actually an asset that is protected from your creditors. Pensions and annuities, again, same thing, where those are protected. I debated putting this in, but again, in conversations with entrepreneurs, assets owned by a spouse, and what I mean by this is, if you can be in a situation where you've got one spouse carrying on an active business and maybe one spouse that is not active in the business, if they've potentially set themselves up where, I'll say, the active spouse runs the business and the not active spouse actually owns their assets, house, cottage, things of that nature. And if no guarantees have been given against that house or cottage, there is the possibility that that asset may not be encroached upon by creditors of the spouse that ran the active business. So I'll often see where people might have a house owned by a spouse that's not active in the business and do everything they can to not let the bank get their claws into collaterally assigning the house value. I didn't want to get into any detail, but the next one is companies owned through a family trust. I'm sure many on the call that have accountants and lawyers might have complicated structures that have diagrams of triangles and rectangles and dotted lines going back and forth. But if you ultimately have a family trust and you have what a lot of people would call an investment or a holding company that's owned through a family trust, and again, where there's not been any cross guarantees given towards any debts or obligations of the active business, then there is the potential that those assets could be protected from creditors. And that's been probably the biggest conversation we've had with clients over the last little bit that have had specific worries about what's protected is their investment money in their company, not their active company, but their holding company, is it protected? And for those that haven't given any cross guarantees and consultations with their lawyer, they're pretty comfortable. So that might be the only thing they walk out of this with. But again, I know one in particular that I've had that conversation with. He will use that money if this business he's in doesn't succeed. He will come out of this and he will use that money to start up a new business, but he'll at least have it. Cash value life insurance. If I own a life insurance policy that has a bunch of cash value in it and I've named my spouse or my children or my parents or my grandchildren as a beneficiary, it could have $1 million in there and none of my creditors can touch it if I own it personally. If my tax-free savings account, I don't want to get into too many details, but there's a thing called a segregated fund. It's essentially a mirror of a mutual fund, but it's sold by insurance companies. And because it's sold by insurance companies, it's actually considered an insurance product. It is a truly investment product, but it has some components of it that it falls under insurance legislation federally, that if you've got your tax-free savings account invested in a segregated fund and a preferred beneficiary being spouse, children, grandchildren, parents, then that tax-free savings account is protected from creditors. And this really hasn't been a big deal the last number of years, but as people's tax-free savings accounts, which is a personal asset, have started to approach, say $100,000 with return and all the investments they've put in, it's becoming more and more significant. So that is one way that we can actually protect tax-free savings account, is specific to a segregated fund. And same thing, if I've just pulled money out of my company for whatever reason and I've got it invested in my personal name, if I have it invested in a segregated fund, and this isn't a sales pitch for segregated funds, they have to fit, and there's some details that maybe people want to know about the seg funds. They're called, short form is seg funds versus segregated. But if I've got money in my personal name invested in a segregated fund and I've named my spouse, my children, my grandchildren, my parents as a beneficiary, again, a creditor can't access that money unless it's maybe something I've dumped in very recently to try and get away from creditors. But if I've done it systematically over the years, there is the potential that I can have those things protected. So then what isn't protected? And this isn't an exhaustive list, but I think it covers most people's questions. Obviously, their active business is something that isn't protected from creditors. It's the first thing people are going to go after. Second is RESPs. Again, it may not be a huge part of a person's portfolio, and a misunderstanding. A lot of times people think RESPs are actually protected if they were to go bankrupt. Alberta is the only province in Canada that RESPs are protected. Everywhere else, they're an asset that a creditor can actually encroach upon. And same with a tax-free savings account. So if you've got a tax-free savings account and it's not invested in a segregated fund, which means through an insurance company, then again, it's not protected. Real estate investments cash value life insurance. If I own a life insurance policy in my company and the company is a beneficiary and it's got a whole bunch of cash in there, then that's an asset that creditors can access. Real estate that I own personally, which could include both rental and or my own house, and any non-registered, not invested in a seg fund. So I don't want to dwell on this any longer, but just to make people aware that certain things are protected and certain things aren't. Sarah? So back to the process we go through with clients, and I think every investor will go through with their advisor, is every company has a risk questionnaire. And And it's really to understand what type of investor you are, you know, in terms of your age, your income, your net worth, and so on. And it basically asks you the same question 6 different ways. And it's basically, how comfortable are you with risk? And we do that to understand what you're like and how you're going to react and what portfolio is going to be appropriate for you. And also to cover our butts, so that if I say our butt being an advisor, if someone comes out as super conservative and they want to be super aggressive, then again, I've got something to go back to them and say, well, but you're answering the questions in this way. So, or if someone comes out super aggressive and they want to be super conservative, then again, we just got some backing on that. From the risk questionnaire, we'll, you know, go through and then develop what we call an investment policy statement, and it really just describes what your goals are as an investor and the strategy that we're going to take to try and meet your objectives. And then from there, we develop the investment portfolio. So we try and match the different investments to the profile of the investor that you are. So again, we'll go back and revisit this. That risk questionnaire, I made the comment earlier that, you know, people have forgotten what risk was. You know, quite often people in the last couple of years would have said, you know, they were comfortable if their investments were to drop by 15 or 20%. Yeah, that's fine, no problem. Partially because they forgot what it was like to have a drop of that significance, or they thought it would never happen. And now that their investments maybe have dropped that 10 or 15%, you know, they're coming back and saying, oh, I'm not comfortable with this. We need to get out of this investment. And we'll always go back to the risk questionnaire and the investment policy statement to say, okay, what's changed? And I think the reality is people are comfortable with, people would be comfortable with a 15% drop if they knew it was only 15. In today's environment, there's no guarantee that it won't go down further than it is today. So that's the uncertainty. But we'll always go back to the investment policy statement and the questionnaire to say, if in fact you're answering the question different than you did 3 years ago or a year ago, then that warrants making the change. Otherwise, we're just using emotion that what has happened in the market has scared you enough that you want to make a change. So that's the conversations that we'll have with clients regarding, you know, what profile of investor they are. Sarah? One of my, I guess I included 3 graphs. I forgot about the line graph earlier. I wanted to show this. This is real numbers just for a balanced investor. And I'll show this to clients and not get into any great detail, but it's really just to point out to them that the best 1-year rate of return, so that could have been 1937 or it could be 2018, but looking back that far, the best 1-year rate of return that person could have gotten was 31%. But really what I'm pointing out to them is, what is the worst that they could have done? Because a lot of times that balanced investor thinks that they can't lose money. And a balanced investor, the worst year performance in Canada, so 30% Canadian equity, so stock, 30% international equity and stock, and 40% in fixed income, they actually lost 16.6%. Coincidentally, that was 2008. So again, when we show this to people that you're a balanced investor and there is the potential, 18% of the time, you could actually lose money. And this is just to reaffirm that they might come out as a aggressive or advanced or balanced or whatever category they come out as, and we'll show them what that type of investor has actually had happen to them in the market over the, you know, a 1-year period, a 5-year period, or a 10, 20, or 30 year. And what this does is it looks at sort of the best 10 years or the worst 10 years. And that's kind of the birthday lottery. Depending on when you were born, kind of determines when you start working and when you start investing. And that actually has a significant impact because of what's going on in the market and in the world. So it's just really to show people how different investors have performed over time. So I'll leave it at that, but you know, can get into the weeds of that if people want. So specific to equities or owning shares, those 2 terms are interchangeable. Equities is usually referred to when people are talking about investment funds. Shares is when people are talking about individual securities. So why do people own shares or equities? And really it's 3 reasons. The hope that the value of that company will increase over time. That's why you own it. You're going to participate in owning that company and as it grows in value. The second reason is you hope that the company is going to be profitable, that you hope that as they make a profit and you're an owner, you get a cut of that profit. So you're going to receive a dividend, hopefully on a regular basis. And the third reason why you'd own equities or shares is because they're more tax efficient than owning fixed income or bonds, because the rate of tax on dividends and capital gains when you actually sell an asset that has appreciated is lower than any other tax rate. So that's why people would do it. The consequence or the cost of owning equities is volatility. The reality is they go up and they go down in value based on market conditions. So it's not without risk. And again, as we've experienced over really the last 10 years, people have only experienced the up, but really the consequence of owning equities is the volatility, and that is the highs and lows. That's the using the yo-yo as you go up the escalator, that it is going up and down frequently, but hopefully the general trend is that as an overall, it's going up. So that's why people would own equities. And if we sort of flip over into the next, my last graph, and there's really, don't worry about the words in the bottom. This is really just to point out that the conversations we've had with clients and what we're doing with clients right now is updating their plans, where what has the impact been on their investments? What has the impact been on their business? And really, what's it going to mean for them down the road? Will they have enough to do the things they want to do? And really, you know, in most situations, red is bad. So in this situation for the client, they have enough retirement income from their age 60, but by the time they get into their late 60s, age 69, they're on track to basically not have enough. And they're not necessarily okay with that. They've got some income, but they don't have what they want. So we do these with every client, and over the last 6 weeks, we've been updating these based on different assumptions that they're giving us or that we're making based on the impact of their investments, based on the impact of their business. And we can include, you know, we thought your business is worth $1 million. We now think it's worth 500,000. What if we sell it for 500,000? Is that going to impact your ability to have the things you want to do, or do the things you want to do, or have enough down the road? So, and just if we skip to the next slide, it's really, well, what can they do about it? And really, this is just to point out that the impact that people can have is how much money they put in, which is either how many dollars they put in or how many years they put it in. How much money they're going to take out. So I want to spend $100,000 a year. I'm on track to have 96. Am I okay with that? So this just really addresses the question of either, you know, how much income they're on track to have, or maybe they need to work a little bit longer, or possibly, you know, we've shown a conservative rate of return and that's not going to cut it. So maybe we need a more aggressive or a higher rate of return, which means taking some more risk. And that goes back to the conversation of the risk profile to ensure that the clients understand what rate of return they need to get on average to meet their goals, and maybe they can even take less risk. So as we move on from there, Sarah, as we start to wind down in terms of, you know, how different investments have been impacted by COVID, and there's no numbers on here, but I'll speak to a few. So a savings account, they were getting zero before and they're still getting zero. Maybe the big difference is high interest savings accounts. People still will see promotions, you know, that they can get. I've seen a few at 2.3%. That's usually a 2 to 5 month promotion. The reality is high interest savings accounts are getting about 0.3%, 30 basis points long term. GICs, there are a few companies that most people wouldn't know about because they're not mainstream, that are offering actually about 2.2% on 5-year GIC, and they're offering 2% on a 1-year GIC. So that spread is usually more pronounced. GICs and high interest savings account and savings accounts are really the only things people can do with their investments to guarantee that they're not going to lose money. That's it. So if people say, I cannot stomach this loss, I can't accept fluctuation, then we go to GICs. The impact of that is it quite often doesn't keep up with inflation. And then whenever they hear they're, you know, the markets have returned and they're doing, you know, 6, 7, 8, 9, 10% rate of return, and they're stuck in at 1.25, they want to switch out. So again, but if you want absolute guarantee that you're not going to lose money, those top 3 are all that you can do. And bonds are essentially where you're loaning money to companies and they're going to promise to pay you back later and give you some interest. And you know, depending on whether it's company bonds or government bonds, they're anywhere from between 0 and 4% with an average of about probably 3. And 3 might be on the high side right now for bonds. And then you've got equities, which we talked about earlier, which are shares. So you've got, the share price. So, different investments that you'll see in the market today, their price is going up and their price is going down. And that's really based on what people see as the value of the company. And then the other part that come with equity, which we spoke about before too, is the profit. So hopefully, as companies are generating profit, that those dividends would continue to be paid out. And specific to dividends and not picking on any industries, I think though, if Loblaws come out and said they were going to increase the dividend because they've been especially profitable, people probably wouldn't fault them for that because of what they've done during this crisis. I think the issue with dividends we'll have moving forward is the impact of dividends from oil companies. Do they have the ability to pay out profit right now? Insurance companies are significantly impacted by low interest rate returns. And obviously the impact on the general insurance of whether that be flood or pandemic payouts, things of that nature. Banks, people think often in Canada banks are immune and don't want to say they're not, but if this pandemic sort of turns into a credit crisis where people can't pay their bills, what impact is that going to have on dividends for banks and financial institutions? So, and then, real estate. So again, a lot of times in Halifax, certainly people that have owned real estate have felt somewhat immune because we're insulated because of government and universities that, they don't have to worry, and not say that they have to, but we've seen the impact where the value of their properties may be perceived to be lower today than it was before, and they may or may not be having some difficulty in collecting the full or any rents on some of their property. So COVID has had an impact on each one of these, and again, I couldn't even speak to the impact that it's had on various businesses. Some businesses are doing especially well as they've pivoted or been involved in things that we need, and a lot of businesses have been significantly impacted because they've been closed or certainly slowed down a lot. So I think the conversation with clients and why I changed this presentation to be a bit more specific onto specific investments is everyone's investments are different, and what you hold in this list of investments might be in different proportion than someone else. So it's tough to say, this is what you should do, because if you're a conservative investor, you should do something different than someone who's an aggressive investor. If you're a business owner, you're going to do something different than someone who maybe isn't a business owner. So that's really just to point out those facts. So as kind of wrap up, and there's been a flurry of questions I can see. Really, I think the message is don't panic, maybe about your investments. They probably haven't performed as bad as you may have thought as you look at sort of the news in the day. Diversify your net worth. I think particularly for entrepreneurs, if you can, maybe not today, but get to a point as you recover out of COVID and try and get some wealth out of your business. That's going to be important in helping you weather the storm and build up a reserve. I think our parents and our parents' generation would have kept more cash. I see Omni's got a question, which I'll read in one sec. Our generation, I say I'm 45, so you can sort of go above or below my age. We've gotten away from keeping cash, and people just think of their line of credit as their cash reserve, but the banks actually want you to pay it back, and they want interest. So I think building up some cash is going to be important. And just before I keep going, so Amine, if you haven't looked at the chat, she said we've seen a major shift in the stock market, and what would your advice be for those that have investments there right now? And I'd say if you don't need access to that money right now for your personal needs or your business, would be to leave it. I was on a call with a fund manager last week, one of the investment companies, and they had basically put their stocks that they owned into 3 categories, and it was green, yellow, and red. And green were companies that they had confidence in that were either doing well and would continue to perform well, and they had no worries. And yellow were the ones that were keeping an eye on, and red were they were worried, so they sold them. And they made that decision because they had some uncertainty of those particular companies and how they were weathering it. So, Amine, as you look at your own individual portfolio and say, do I need the money? And if you don't need the money and you've got time to allow it to recover, that's what I would do. If there are certain investments in there that you've got to worry about, I would have the conversation with your advisor and look at the individual investments and say, I'm in oil and gas right now and I'm worried about oil and gas. Part of it goes back to no one has a crystal ball. If they tell you they do, they're full of it. But the reality is, do we think that oil is going to be at $19 a barrel 3 years from now? And if you don't believe it is, and you're currently investing in something that involves natural resources, you've already lost the money. And if you only lose it if you sell it now, so if you've got time to recover and you've got confidence that oil will cost more in the future than it does today, then I would kind of stick it out. Economic recovery. So question being, what are some of the key events that would indicate a recovery is happening? I think some of them have already happened. And what I mean by that is the doom and gloom of the market has kind of been priced in right now. Like if you look at the valuation that people have for companies, like pick a company, that's based on how they think it's going to perform, knowing everything they know today moving forward. So key indicators, I think, are where you've seen some good news. The ultimate key indicator is going to be the first real vaccine, and not that people are going to trial, although those companies have seen probably an appreciation in their share value. But when the news starts to become more substantive that a vaccine has been found, that it is being produced, that it's proven, that it's being produced, and it will be released, which realistically is 18 months from now. But again, the markets have priced that we're not going to have a vaccine for 18 months. So that recovery is really only able to be seen after it's happened. But the things you look for are some good news stories. And you start to see some of the earnings. I think probably the next indicator would be the first quarter earnings included January, February, and the first half of March, which COVID really hadn't impacted that much. The second quarter earnings have been priced into the market, but you might see some companies that have performed better or worse than they thought they would. So that might impact their value moving forward. But I think it's going to be sort of weathering this over time. Should people be moving out of the energy sector given that oil is being given away? I think if you are in oil right now, and not speaking specific about an individual security, just so that we say that not breaking any rules, but if you're in oil right now and you're thinking of getting out, you are doing exactly the worst thing. And that's not saying don't get out, but you are selling at a low. And when emotion takes over, people will buy at a high and sell on a low. So you've actually not lost any of your investments in, say, oil, unless you sell them today. The same as that value of the investment was never worth what it was worth 2 years ago when oil was really high, unless you sold it that day. So, I think there are some oil companies that will come out of this strong. There are some oil companies that will be hammered by their debt and won't be able to recover. That's where I go to the professional money managers to do that analysis, to be able to look at them, those companies, and do that decision making of whether they're going to make the decision to buy or sell. I think as an individual investor, it's pretty tough to make a prediction on oil. Other questions, what is the opinion of purchasing real estate for the purpose of an income investment during this time? I will never discourage anyone from buying real estate. I think certainly you look at people that have significant wealth, a lot of times it came about from owning real estate. Certainly there's uncertainty right now with people being able to pay rent, but I think, the clients of mine that have residential real estate, certainly the ones that have done a better vetting process or have people in their buildings that continue to earn an income, I think they're going to continue to do well. even the lower income people where they've been able to access some social programs that the government has rolled out, they might do okay. It's the people in the middle that I kind of worry about, but certainly the access to cash right now, if you can find a lender that'll give you money, which I think they're very forthcoming, but again, you've got to jump through their hoops, and the price or the cost of borrowing money is really cheap. I think it'd be a great investment to buy real estate, and you can't have an investment presentation without quoting Warren Buffett. And his, I think my favorite quote of his is, be fearful when people are greedy and be greedy when people are fearful. So if everyone's running away from real estate, that's probably the time to run towards it, as long as you have the long-term view and the deep pockets to be able to weather the short-term hiccups. So back to the recap, do regular deposits. So again, for younger people and even older people that are putting money into the markets right now, you're buying at a discount. So it's a tremendous opportunity to be buying. Reduce the risk in your portfolio the closer you get to needing the money. So what that means is, I don't have a whole lot of sympathy for someone who's in their 60s that has just lost a significant part of their portfolio because they were invested 100% in equities or risk. As you get older, I think you got to pull some of your chips off the table and get a little bit more conservative. That doesn't mean get out of investments or get out of equities, but I think, reduce the risk in your portfolio, certainly for the money that you need to access during your lifetime. Protect your assets to the extent that you can. So that goes back to, again, business owners in the past traditionally maybe haven't used RRSPs. They've reinvested back into their company or put money into other things. But now knowing that those assets would be protected from creditors, I think is something that's important. Be aware of tax planning. Notice it's at the end of this and not the beginning. I think there are tax strategies that you can put a lot of effort into that save you some money. And there's tax strategies that you do that you put an awful lot of effort in and they only save you a little bit of money. But be aware of different tax implications. And I think having a written plan and having it updated so that you know the impact of what things were like in the past and the new reality of what has happened and what impact that'll have on you in the future, to really answer the question of, are you going to be okay, and can you do the things you want to do at some point in your life whenever you may want to work a little bit less than you work today. So that's kind of the recap and the message. If we have anyone else left with any questions. Hearing none, meeting adjourned. Michelle or Amine?
If anybody has any questions and cannot find the chat feature, feel free to unmute your microphone. All right. Well, probably we don't have many more questions because, Andrew, you've definitely provided us with so much great information here and lots of good advice. And speaking of wealth, you have provided us with a wealth of information. And the graphs that you included were actually helpful so thanks for that. Hopefully we all today, I know I have definitely been provided with a great perspective on how this pandemic is really impacting our investment portfolios, and just getting a better understanding of what kinds of investments are protected and which are not has been really helpful. One thing that resonated with me is, although investing styles are all different depending on, of course, one's personality and what their goals are, one thing is clear, and that's that everybody should be thinking about diversification right now. Diversifying our business, our net worth, and of course our investments. There's a certain point in life where we all look at making changes to an investment portfolio, and this COVID-19 is definitely one of those times that we should look into see what can we do to benefit this time. I've said this at another webinar we hosted, but it seems to be a reoccurring message that, cash is king right now. And that's all something we should definitely try harder to do. So again, thank you, Andrew, for this information. We will be we will be posting this webinar on our website, and we will have Andrew's slides. So if you want to revert back, please check out our website. And if anybody has any questions, please reach out to Michelle Levine or Andrew. We will continue to provide more Staying Connected webinars, and we definitely encourage you to visit our website, familybusinessatlantic.ca, to see all of our upcoming webinars and our offerings. Help us build our family business community, and please share us, share our Facebook link and also our LinkedIn portfolio. Together, we will get through this confusing and challenging time. And just for those who are not members on the line, Family Business Atlantic members, we are a family. And again, we'd be happy to chat with you if you are interested in learning more about our association. We are here for you to lean on, so please provide the please attend the programs that we are providing. So thanks again for joining us today, and thank you, Andrew. And we will touch base again at the end of the week.
Thanks, Amine. Thanks.
Have a great day.
You too.
This conference will now be recorded.